Building wealth takes time and effort, but it is possible. By following Warren Buffett's advice, you can increase your chances of achieving your financial goals. In case you don't know, Warren Buffett is an American business magnate, investor, and philanthropist who is widely regarded as one of the most successful investors of all time. As of September 4, 2023, Warren Buffett's net worth was estimated to be at $121.1 billion. His net worth is largely derived from his ownership of Berkshire Hathaway, a multinational conglomerate holding company that he has run since 1965. Berkshire Hathaway owns a wide variety of businesses, including insurance, railroads, utilities, and consumer goods companies. Warren Buffett is the fifth richest person in the world. Buffett's annual letters to shareholders and his quotes on investing and wealth creation are widely studied by investors and business enthusiasts around the world. His wisdom and investment strategies have inspired many to follow in his footsteps in their pursuit of financial success, and his advice on wealth creation is worth listening to. You're watching Genesis on Money, the channel where we navigate the complex world of personal finance and wealth creation. Here are some of Warren Buffett's best tips on wealth creation. 1. Rule number 1, never lose money. Rule number 2, never forget rule number 1. This is Buffett's number 1 rule of investing. He believes that it's better to sit on cash than to invest in something that could lose you money. This advice encapsulates the fundamental principle of investing and wealth preservation. It's a concise reminder of the importance of minimizing losses as a top priority in any investment strategy. Buffett is by this advice emphasizing that the primary objective for any investor should be capital preservation. Protecting your capital from significant losses should always be at the forefront of your investment decisions. By focusing on avoiding losses, you not only protect your financial resources but also ensure that you have the foundation to grow your wealth over time. In other words, if you can successfully prevent significant losses in your investments, you'll be in a stronger position to generate positive returns. Buffett's advice is a call to prioritize caution, research, and careful consideration before making investment decisions. By following this approach, you aim to avoid the erosion of your wealth that can occur with risky or ill-informed investments. Importantly, the repetition of the phrase "never forget rule number 1" by Buffett is his way of emphasizing the critical nature of this principle. It underscores the idea that regardless of market trends, economic conditions, or investment opportunities, the focus on preserving your capital should remain constant. In essence, this advice should serve as a guiding principle that encourages you to prioritize protecting your capital and avoiding significant losses, bearing in mind that doing so is essential for achieving long-term financial success and wealth creation. 2. The stock market is a device for transferring money from the impatient to the patient. This particular advice in the form of a quote illustrates Warren Buffett's perspective on the dynamics of investing in the stock market. It underscores the importance of patience and a long-term mindset when it comes to successful investing. Buffett is reinforcing the fact that the stock market often rewards those who can remain patient and hold on to their investments over time. Impatient investors who are driven by short-term fluctuations and quick gains may find themselves making hasty decisions based on market volatility, news, or emotions. These decisions could lead to buying and selling stocks frequently, which can result in transaction costs and potentially missing out on the long-term growth potential of quality investments. On the other hand, patient investors who are willing to hold on to their investments through market ups and downs are more likely to benefit from the overall upward trajectory of the stock market. This is because, over the long term, well-managed companies tend to increase in value, and patient investors who hold these stocks can capitalize on that growth. The quote-like advice suggests that impatience can lead to poor decision-making, while patience allows investors to capitalize on the compounding effect of time. This concept aligns with Buffett's own investment philosophy, which emphasizes finding high-quality companies with a competitive advantage and holding on to them for the long haul. Let's just say this is Warren Buffett's way of serving a reminder that successful investing involves having the patience to weather short-term fluctuations and the discipline to stay committed to a long-term strategy. Those who can remain patient and avoid being swayed by short-term market movements are more likely to be rewarded as the value of their investments appreciates over time. 3. Risk comes from not knowing what you're doing. Again, this quote-like advice underscores the importance of knowledge and understanding in the world of investing and financial decision-making. It emphasizes that the greatest risks often arise when people lack a clear understanding of the investments they are making or the financial decisions they are undertaking. Here, Buffett is cautioning against making uninformed or impulsive choices in the realm of finance. When you invest in assets you don't fully comprehend or engage in financial activities without a solid grasp of the potential outcomes, you expose yourself to unnecessary risks. Investing always carries some degree of risk, but informed investors who have thoroughly researched and understand the companies or assets they're investing in are better equipped to assess the potential risks and rewards. They can easily make more strategic decisions that align with their risk tolerance and investment goals. This advice also reflects Buffett's value-oriented approach to investing. He is known for extensively researching and understanding the businesses he invests in, seeking to identify companies with strong fundamentals and competitive advantages. This approach reduces his exposure to unknown risks. In essence, the quote-like advice serves as a reminder that risk can be mitigated through knowledge and education. When you take the time to educate yourself about your investments and financial decisions, you will be better positioned to make informed choices that will easily align with your long-term goals and minimize the potential for unintended negative outcomes. If you enjoyed watching this video, you'll enjoy part 2 even more. So if you're not subscribed yet, why not do so now so you don't miss out on my forthcoming videos? Also, don't forget to like and share this video. Thank you and bye for now. I'll see you on the next one.